from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, antitrust showdown. The House takes up a series of bills that could change the internet as we know it. Meantime, tech giants mount their defense. We'll have the latest. Plus, Bitcoin rebound, but there may be more choppy waters ahead as China enforces its crackdown. And the next shoe to drop, maybe more U.S. regulation. We'll explore. And the resale market is expected to more than double in size to $77 billion over the next 5 years. We're going to check in with the Real CEO, Julie Wainwright, on how she is positioning the company for demand as she celebrates a decade in business. All those stories in a moment, but first, NASDAQ climbing for a third day and Bitcoin bouncing back. Let's get straight to Bloomberg's Ed Ludlow, who has more. Ed, walk us through the day.
Yeah, rebound in Bitcoin. We broke out down below 30,000 US dollars. You can see this pronounced rebound, and then throughout Wednesday, trading in a range of 33,000 to 34,000 US dollars. Everyone is trying to make sense of this. Come with me into my Bloomberg terminal, look at this chart, and Emily, let me give you my stat of the day. Because what we were talking about was the death cross, right? This issue of Bitcoin's 50-day moving average falling below its 200-day moving average. So what? Let's bring in the stat of the day, because this has happened 7 times previously since 2010. In 5 out of those 7 occasions, Bitcoin actually rose in the weeks that follow, on average by 34%. But you see that yellow line there? That's the 30,000 mark. And the concern was that if we drop below it, would we continue to drop further? History tells us no. The market consensus tells us yes. Elsewhere, we were kind of treading water in US equities today. The stock market really did not have any direction. Some slight outperformance in tech shares. The NASDAQ 100 basically flat, but the NYSE FANG Plus Index, that basket of mega cap tech stocks, actually pronouncedly higher. Tesla really leading the way, rising by the most in 6 weeks, its highest level since May. Elsewhere, semiconductors higher. And in the Bloomberg Galaxy Crypto Index, we talk a lot about Bitcoin, Ethereum, but there were other coins making gains as well, Litecoin and EOS being examples that you can ask your guests about later. And some of those crypto-related stocks, finally, they had been much higher earlier Wednesday when Bitcoin rose, but kind of fell away towards the end of the day. Again, the market is looking for direction, it's looking for news flow. It was a pretty quiet day.
All right, Ed Ludlow, thanks a lot. Meantime, the House Judiciary Committee's consideration of antitrust bills targeting big tech has begun, with bipartisan pledges to use legislation to break the hold that the largest companies have on the internet economy. Here's a breakdown of the bills.
The first House bill aimed at big tech would prevent companies with online platforms from giving their own services an advantage over competitors. For example, it could limit how Apple presents its own music and messaging products on iPhones because companies like Spotify and Facebook's WhatsApp depend on mobile phones to reach consumers. The next would force the selling off of entire lines of business. In one scenario, Amazon could be told to sell its logistics network of warehouses and delivery hubs. A third measure aims to make it easier for users to move data, like photos and contacts, from one service to another, like from Apple to Google. And the fourth bill would create a new M&A law, making it easier for regulators to block deals they see as anti-competitive. The remaining 2 measures have companion bills in the Senate, giving them a better chance of becoming law. One would give the Justice Department and the FTC more resources to pursue antitrust cases. The other would make it easier for states to bring antitrust cases under federal law. The House thinking that by breaking up legislation into smaller pieces, each of them have a better chance at becoming law.
For more on what big tech should expect from these bills, I want to bring in Bloomberg's Anna Edgerton. Anna, you were watching the House floor and the discussion all day long. What is the big takeaway? Can Republicans and Democrats agree?
Well, there's certainly enough that they do agree on. We've been going for 7 hours now and have only gotten through 2 of these 6 bills. So it's a pretty long slog. We're hearing lots of amendments from both sides, and there has been a lot of bipartisan agreement. However, there is some pushback from Republicans, especially about whether or not these measures would do enough to fix what they describe as censorship of right-wing users. So there's a lot to be discussed, and whether or not these antitrust rules are the best way to go about doing it.
Now, Republican Congressman Ken Buck talked about the approach here as a scalpel, not a chainsaw, to break up these big ambitions into smaller bills that have a greater chance of succeeding. Do you think that strategy is going to work?
Well, that was a really interesting quote from him. And I think what he was getting at is that these bills are narrowly tailored to affect just 4 companies: Facebook, Apple, Amazon, and Google. Now, the legislation doesn't mention those companies by name, but the way the criteria are written suggests that those would be the only companies affected. This is different than the Senate approach, where Senate Antitrust Subcommittee Chairwoman Amy Klobuchar has taken more of a broad approach, looking at the whole economy. The House has really targeted just big tech. They're looking at measures that would only affect these big companies. So I think that's what he means by taking a more tailored approach, using, as he described it, a scalpel. On the question of whether or not these bills could actually become law, I think they will pass out of the Judiciary Committee with bipartisan support, but I don't know if they have enough support to even pass the House. There's a lot of concern about what these bills would do to products that U.S. consumers really enjoy, like Google Maps, the iPhone applications like iMessage. So it's hard to see whether or not these would get enough support to even pass the House, much less the Senate.
All right, Anna Edgerton, continuing to listen in to that House debate. Thanks so much for bringing that to us. Lots more discussion to be had, only through 2 of the 6. Thanks, Anna. I want to stick with this and talk about how all of it could impact the tech industry with Adam Kovacic, who previously led Google's U.S. public policy campaigns on privacy, security, antitrust, and more. Good to have you back, Adam. How much of a threat is this to big tech in this moment after years of avoiding this kind of scrutiny?
Well, look, tech's honeymoon is over. I know that. This somewhat limit, for example, their ability to do acquisitions, I think, affect them. I think the biggest bills they're concerned about are the ones that affect their ability to improve their products to delight consumers. So if I get a new iPhone and it doesn't come with any app installed, no iMessage, no FaceTime, that might be something that Zoom or Facebook Messenger like, but that's not something that most consumers want. I don't see consumers marching on to say, make my iPhone work less well. I want Amazon without Amazon Prime. I don't see that happening, right? And so I do think that one of the when it's about this debate is that the companies I think are trying to up for their own ability to keeping and delighting their users. That's one of their concerns. In addition to the business, they're real.
So, I want to challenge that a little bit because it's very much along the lines of what we have heard from Google saying that this would break up customers' favorite products. And yet consumers have expressed concerns about things like tech addiction, about, some aspects of the power. Amazon sellers, for example, have expressed the power of the Amazon platform and Amazon's ability to sell its own products that compete directly with their own sellers. So, it certainly seems like there is consumer concern there, but possibly for different reasons.
I agree. Look, I think one of the things in organization, the Chamber of Progress just did a survey conducted by Molt, and what that survey found is that if you ask voters, are you concerned about tech? Do you want tech to have greater regulation? Generally speaking, they say yes. But I think what we find is that we're seeing right now a real laboratory debate of what specific ideas would do, right? So you're right. So if you say something like Amazon can't do Amazon Prime, that might help, say, Walmart, right? Or Amazon can't provide Amazon basic batteries. That might help the small supplier. It might help the competitor, and I think that's true. Some of the things that Apple is limited to do could help us fight, for example. But that's not really why we write competition laws. Really, in this country, writing competition laws to advantage a competitor, at least we should really be aimed at delighting the consumer. And sometimes, that does impact on a competitor. But I think that's one of the things you see about these, a lot of the companies who are competing against like them.
Adam, we're going to have to get out of this. We're having some problem with your audio, but I do get the high points of what you're trying to say. Former head of public policy at Google and current CEO at the Chamber of Progress, Adam Kovacic, who worked a very long time for Google. Thanks for joining us. Meantime, coming up, we're going to get back to Bitcoin. Just what is its rightful place in the currency universe? We're going to talk about that with FX watcher Mark Chandler of Bannockburn Global Forex. That's next. This is Bloomberg.
The conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important. Could crypto become a really important asset class one day? Sure. If there was a digital dollar, a true digital yuan, that will change however, that would be much more impactful than any other, like a crypto.
BlackRock Chair and CEO Larry Fink earlier on Bloomberg Television downplaying the prevalence of cryptocurrency in his chats with companies. I want to see how prevalent crypto is in Mark Chandler's conversations these days. So he is the managing director of Bannockburn Global Forex. Mark, how prevalent is it? Are you having the Larry Fink situation?
Yeah, no, I have the same experience, partly because we're talking about the same universe, corporations, companies, and typically the Treasurer's office is really trying to manage risk, not take on new risk.
So what does that mean? Does that mean customers aren't interested in crypto?
Well, I think that means that their business isn't. So you think about it, like, right, say a U.S. Company is buying a good from Germany or Japan or China, and they're going to trade most likely in the U.S. dollar. Why would they have crypto? It gives them a new exposure that doesn't come out of the business. And typically corporations are trying to avoid that kind of risk. Currency risk management is a very important function for a lot of large companies, and they typically don't want to take on new risk needlessly.
So how are you looking then at crypto as an asset class? I mean, are you following the ups and downs of Bitcoin? We're at $33,000 now, but are we going to hit a new near-term low before some longer-term potential climb?
Yeah, so I do follow crypto, partly because I do think that there is, as Larry Fink had said, a possibility that it is a new asset class. But what we've seen in the recent several weeks, I think, it sort of gives that, what the internet calls HODL, hold on for dear life, all new meaning, going through, basically giving back everything it made this year, while inflation, price pressures still seem to be rising. The one hedge it was supposed to be, because theoretically of limited supply, it was supposed to protect us from inflation, and it's not really working out so great.
Now, if you're a retail investor or an institutional investor, why invest in crypto at all at this point, given the volatility, when clearly, at least so far this year, you can get better returns elsewhere?
I think that's exactly the point. I think that's why, the crypto space, they really pride themselves on decentralized finance. But when I see the surveys of people looking at the IP addresses of the ownership, it looks to me like something like this. Crypto is born in countries in which there's great disparities of wealth and income. And I think the crypto space is picking that up as well. Highly concentrated retail hands, really large retail hands, highly concentrated still. You say that Bitcoin today is around $33,000. And I think that most of the coins are owned by those who have 100 or more, which really excludes, the average American median family income in the U.S. is only about $65,000 or so. So I think that there's really not much space, except I think that there's some people who still see it as offering some kind of diversification, because it doesn't seem to be correlated with other assets right now.
Okay, now obviously we know that China is cracking down. We're waiting for U.S. regulation. Clearly, some kind of regulation is coming. How much do you think that could further dent the momentum of this entire market? And will it completely change the market that's to come?
Yeah, so I think that the crypto space has two big challenges coming up. One, as you mentioned, is the regulation. I think, the U.S., first maybe talk about China. You say they're cracking down on crypto, but I sort of see them doing is enforcing a rule that's been on their books, so to speak, for several years. So the first thing I think is just China is putting some teeth behind their policies. Secondly, I think that the U.S., Western Europe, is not going to be so much banning crypto as some people fear to protect the monopoly, but rather regulating it, making sure that it's not being used to do some, say, undesirable activities. But I think that the other hurdle that's going to be coming, besides the regulation from America, is I think that as Larry Fink had mentioned, the possibility of a crypto or a Bitcoin issued by central banks, central bank digital currency, whether it's China, Sweden, other countries are looking at it like Estonia. I'm not sure why the U.S. needs one per se. I do see there's some clamor for one, but I'm not so sure that changes things. I think that the reason that Chinese currency is not being used that much in the world, and you see this in the SWIFT surveys every month, less than 2% is being accounted for by China. I don't think that's because of a technology gap. I don't think we're not using it to invoice trade because they don't have a digital form of it. So I think that it's not going to really change the current order of things if China is the first to come out with that digital currency, perhaps in time for next year's Olympics.
So look, and this is the $1 million question, or maybe the $33,000 question at the moment, but if you look ahead 5 years from now, how are we going to look back on this time?
I think that the excitement around crypto, at its peak, it was about $2 trillion, the market capitalization. I think this is a symptom of the times, just like sports gambling is, just like having lotteries in America to fund schools. These are parts, I think, of sort of the excesses of our society right now. It seems, we have $13.5 trillion of negative yielding bonds in the world. I think that just is reeking of excess savings, excess capital, searching for a home.
So does that mean you think the crypto market is going to collapse in some way?
I don't know about collapse. I am watching this, say, 27,000, 30,000 in the Bitcoin. It's a very important, technical point. And technicals seem to be important because there's no intrinsic value. There's no use value, really, except finding someone who can buy it from you at a higher price. So I think psychology plays a big role. So I look at technical analysis for it. And I just think that if we go through that 27 to 30,000 level on Bitcoin, a lot of people who have been holding on will have second thoughts. But I'm not sure if it's going to be a growing asset market. Sure, it might stick around. It doesn't cost a lot of money to float one of these currencies, even if some of them are launched as jokes. So I just don't think they'll be capturing our imaginations going forward.
Well, it's certainly interesting to hear your perspective after hearing from so many crypto bulls. Mark Chandler, Bannockburn, Global Forex Managing Director. Mark, thanks so much for sharing your perspective with us today. Meantime, the cybersecurity software pioneer John McAfee has died in a Spanish prison. News of his death came hours after a Spanish court approved McAfee's extradition to the United States. He was arrested in Barcelona last year on tax evasion charges for failing to file tax returns for 4 years. His defense team had argued the extradition request was politically motivated. He was also accused by the SEC of hiding cryptocurrency income of more than $23 million. He was 75 years old. Coming up, another shakeup at the Bill and Melinda Gates Foundation in the wake of their high-profile divorce. We're going to have all the details next. And shares of Roku and Viacom rallied on a Wall Street Journal report that Comcast CEO Brian Roberts might make a bid for one of those companies. The speculation following a flurry of big media deals, including Amazon's acquisition of MGM and AT&T's agreement to combine its Warner Media division with Discovery. This is Bloomberg. Trillions of dollars in assets may need tighter rules, according to SEC Chair Gary Gensler, who spoke earlier on Bloomberg Television about everything from meme stocks to SPACs. Take a listen.
I'm going to be animated every day in this job by working families. And working families need the protection. And Franklin Roosevelt knew this in the 1930s. We know this now. President Biden knows it. It's about working families, ensuring they get the disclosure so they can make their choices in the markets. And there's a cop on the beat protecting against fraud and manipulation. That helps companies raise money too, by the way, by lowering the fraud and manipulation, ensuring that there's consistent disclosure to those investors. I think companies benefit as well.
Disclosure is a broad concept, so let's narrow in on that. Where specifically do you think we need more disclosure?
Well, I think there's trillions of dollars of assets under management now calling for greater and consistent disclosure around climate risk. And when I've also asked staff to take up disclosures around human capital, the most important, really fundamental asset of a company, the people that work there.
Gary, thank you so much for joining John and I this morning. I'm going to go broader here, Gary. I have never seen a primal cry for an SEC commissioner to just do something. You mentioned something I mentioned an hour ago, which is FDR. I'll go to the Commonwealth speech early in the Depression. There is a primal scream, Chairman, to do something. What is the do something you want to do to help us with meme stocks, with SPACs and other things I don't understand?
Well, Tom, you're being a little immodest. I'm sure that you understand them a little better than that, and your listeners have listened to you for years. But look, what I think the important thing is investors want to know there's somebody looking after them. Working families, pensioners, people that have 401ks. So you mentioned special purpose acquisition companies, or so-called SPACs. It's really making sure that the sponsor who's behind that is fully disclosing their take on it. These are very expensive, dilutive products. I mean, the sponsors take out a chunk at the beginning, then there's more being taken out later when they merge with a private company in what's called a de-SPAC. I just call that a target IPO. And it's those disclosures ensuring that the retail investors get the right disclosures and are protected and somebody's not misleading them. And secondarily, that they're participating just like the institutional investors. And a lot of the big institutions buy into these SPACs later during that target IPO, and they do so at a preferred price rather than the price the retail public's getting.
SEC Chair Gary Gensler there with an important steer on what's to come. All right, coming up, we're going to talk about the competitive landscape for new media with the CEO and founder of Substack, Chris Best, pioneering a newsletter revolution. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Let's get back to our Ed Ludlow now, who's got a little lesson on what you could call the ABCs of markets. Educate us, Ed.
Love it. So you want to invest in Google. Do you buy the Class A shares with voting rights or the Class C shares without voting rights? You can see they're both lower on Wednesday. To confuse matters further, you have Class B shares owned largely by the founders of Google who control the voting rights. Come with me into my Bloomberg terminal and let's explain why we care. Over the last few weeks, the Class C shares that do not have voting rights have kind of outperformed. You can see there, that's the price gap between the two. The Class A shares with voting rights have closed around 4% lower. Normally, over a longer time period, they have a premium over the Class C shares of 1.3%. You come back to me in the studio, you put them side by side, you can see the yellow line, far left-hand side of your screen, the Class C shares, no voting rights, have outperformed after moving in lockstep for such a long period of time. And finally, compared to the rest of the FANG stocks, those big cap tech stocks, both of them outperforming the whole basket. And my question to the audience, if you're out there and you know the answers, if you're an investor, why would you want the shares that don't give you a right to vote? Tweet me, call me, email me, because I want to know the answer. One theory is that Alphabet, the parent company of Google, its share buyback program is largely around the Class C non-voting shares. But it's a mystery. I love mysteries, but I also want to know the answer. So, Emily, get the audience to let me know.
At Ed Ludlow on Twitter. He's got a pretty straightforward Twitter handle. Somehow got in there early. Thank you so much. Well, if you've read a newsletter lately, it might have been published via Substack. The subscription platform says it's aiming to create a better future for writers by giving them ownership of their ideas and a direct relationship with their audience. For more on the company and the competitive world of new media, we welcome back Chris Best, the founder and CEO of Substack. Chris co-founded the mobile messenger app Kick before this. So Chris, it's been 4 years now since Substack launched, but it feels like in the last year especially, you've seen so much more momentum. As the Wrap puts it, Substack has become almost synonymous with the word newsletter. Talk to us about the recent momentum that you're seeing. What trends are you pulling out?
Yeah, we think that writers have one of the most important jobs in society, because their work shapes how we think and how we see the world. And the social media which has made us angrier and dumber, has also really hurt writing and writers, right? It's made it hard as a writer to do the work you think actually matters and to make money doing it. And Substack is about providing a new way for writers, right? We make it simple for a writer to go independent, own their own work, and get paid directly by their subscribers who they show up in their inbox. And this frees writers to do great work, which is also important for the rest of us who depend on those writers to help shape how we see the world.
We were taking a look at some of the most popular Substacks out there, and obviously, some of these folks have, legions of subscribers. However, Facebook, Twitter, they're making moves and trying to give creators the tools to do this themselves on their platforms. How much of a threat is that to Substack?
It's nice that they've noticed that this is happening. I can't help but feel like these are the companies that have created a lot of the problems that Substack is designed to solve, and I can't imagine their solution being the right one.
Why not?
Because when you have a business model that's based on advertising, your whole goal is to keep people as addicted as possible to your product. You want to maximize engagement at all costs. And this dynamic, the fundamental logic that underlies so many of these social media giants, is just at odds with readers and writers. It means the company's interest is against your interest as a reader and your interest as a writer. And so even if they make an imitation Substack, it's never going to be able to truly let writers go independent.
So some of the most popular Substacks out there, Emily Oster, I subscribe to her, Sam Irby, Matt Stoller. Also, my former colleague, Eric Newcomer, left to do a Substack of his own, great content, and he just did one about the future of media, and Andreessen Horowitz launching its own new media website called Future. So we're getting very meta here. How do you see these trends, Chris, changing the competition between traditional and non-traditional media?
We don't really see ourselves as in competition with traditional media. We think traditional media is important. It has an important place in the media landscape. We really think that Substack is a new way, a new kind of a thing that is most directly in competition with kind of the engagement-based social media world, which has been causing a lot of trouble both for writers and for legacy media.
And yet, a lot of these journalists, they don't have editors. Things get long, and also I often see great nuggets in their news that's not being amplified on social media or re-reported in other media. How big a problem is that? And are these going as far as they would be going on a traditional platform?
We think that editors are actually quite valuable, and some people on Substack hire editors and use them, but what really matters on our platform is we're putting writers and readers in charge. So you're a writer on Substack, you're the boss. You get to decide what you publish, you get to decide what work you think is most important. And it turns out that when you give writers that freedom, they're able to do a lot more interesting and valuable work because they're not beholden to make everything the clickiest story and to try and play the go viral with every piece game. They can create a lot more value for their loyal subscribers and frankly do better work because of the model.
Then, of course, there's the issue of the money, and I know this is about empowering writers to follow and pursue their own ideas, but how much money are these writers making? And on balance, are they making more money than they would make in a traditional media job?
You would be surprised. I mean, if you start to think about the math, if people are paying $5 or $10 a month, you only need a few thousand writers to make more money than basically any traditional media job provides for a writer these days. And so there are many, many writers on Substack who are making more money in this new independent model than they ever could have hoped to earn at a legacy publication. And it's because they're creating this value for their subscribers.
Now, of course, there are platforms that have tried to do this in different ways. I'm thinking about Medium. Do you consider Medium competition anymore? Is Medium becoming a thing of the past?
I think the biggest differentiator for Substack on this front is the independence that we afford to writers. And what does that independence mean? It means that when you're a writer on Substack, people are subscribing directly to you, right? You are getting the right to reach out to them in their email inbox. When they're paying for you, they're paying for you. And so we have this kind of direct, trusted relationship, which is better for the writer because they can make more money, because they have more power, because they get to do the work they think is valuable. But it's also better for the reader because they feel like they get to choose their heroes. They get to choose who they're subscribing to, who they're inviting into their mind. I think Substack is the first platform that really gets this right.
So it's been 4 years. Give me the view in the next 4 years. How do you imagine that Substack will have changed the business? How much of my time, a general reader's time, will be spent on Substack newsletters versus everything else?
You know, one of the most exciting things about Substack to me is not the famous writers who are leaving their publications to go independent on Substack, although we love that. It's great. I'm thrilled that this can provide a new option for many of those people. The thing that's most exciting to me is all the people who are finding massive success on Substack as writers who, but for this model, would not have been able to be writers. These are people who are academics, who are working in industry, who've become lawyers, who've gone to do other things, always felt like they had something to give the world as a writer, but never could make it work, never could make the money, never could have the independence until they found a model like this. And so when I think about the next 4 years of Substack, the thing that I'm most excited about is this massive potential energy of smart people who have something to give the world as writers that this will now unlock. And I think that market, that value can be much greater than, you know, the legacy newspaper industry ever was. And I think that's like an exciting potential to unlock.
All right. Fascinating. We'll be watching for that potential to be unlocked. Chris Best, founder and CEO of Substack. Thanks so much for joining us.
Thank you.
All right, let's look now at some other stories we're following. Warren Buffett has resigned as a trustee at the Bill and Melinda Gates Foundation. His departure coming as the charity grapples with the upheaval created by the divorce of its founders. But in a statement today, Buffett says his goals are, quote, 100% in sync with those of the foundation. He also announced he's reached the halfway mark in giving all of his Berkshire Hathaway shares to charity. And the wait time for semiconductors has hit a record 18 weeks and continues to affect industries from cars to consumer electronics. Research by Susquehanna Financial Group shows that's up by 7 days from the previous month. The gap already the most since the firm began tracking the data in 2017 and 4 weeks longer than the previous peak in 2018. Coming up, are we about to see a two-wheeler come back? We're going to speak to one company that smashed, bashed, and deliberately crashed its new scooter to prepare it for post-pandemic commuters. Our City Lab segment is next. This is Bloomberg. Tesla and smaller EV stocks jumped Wednesday, outperforming the broader market. Digital automotive marketplace Cars.com announced that the Model 3 topped its list as the most American-made vehicle for 2021. Meantime, Nikola said it's investing $50 million in exchange for a 20% equity interest in a clean hydrogen project in Indiana. Well, How are you getting back to the office? E-scooters littered the streets across America after taking off in the summer of 2017, but COVID-19 has kept a key customer at home. Now, the industry is hoping to capitalize on a post-pandemic commuter wave. Bloomberg's Ed Ludlow caught up with one company, Spin, that's showcasing a scooter with some cool new features. It is our City Lab segment of the week.
Cities are coming back to life, offices are reopening, and commuters are looking for quick, eco-friendly ways back to work. One of the options employers are incentivizing, the electric scooter. E-scooters really took off in the summer of 2017, but when the COVID-19 pandemic shut down the US in March 2020, scooter sharing companies suffered.
When things first started to hit, there was about a 90% decline in ridership across the board.
The few scooters you may have seen on the street were more than likely being used by frontline or essential workers. Spin wants to seize the moment and has a new scooter packed with tech for the post-pandemic world. Most scooter companies buy off-the-shelf scooters and slap their labeling on them, but this scooter is designed and built in-house. We took one for a ride. The S100T has a more powerful 500-watt swappable battery pack for longer range, faster acceleration, and less environmental impact. And it can see the world around it. Ben explains how.
It's basically cameras and sensors on the scooter that goes through an AI algorithm, and it basically says, am I on a sidewalk? Am I on a bike lane? Am I parked correctly? And then it can deduce that in real time and provide audible feedback.
The technology is about enforcing good rider behavior, which Spin hopes will make more cities get on board. The company ran hundreds of tests, bashing and smashing the scooter to prove its durability and safety. It's a dynamic industry. The main players globally have raised more than $3.5 billion since 2017, according to Bloomberg NEF. Spin was bought by automaker Ford in 2018, and it's grown to be the third largest scooter sharing company by sales in the US, behind Bird and Lime, according to data tracked by Bloomberg's Second Measure. The company is San Francisco based, but it's launching its new two-wheeler in Sacramento. Its biggest market is Washington, D.C. With more markets up for grabs, will Spin's technology convince hesitant city officials?
A more durable scooter will last longer, you don't need to replace it as much, so naturally it's got better environmental credentials. Are they safe to drive? So a better scooter is obviously going to get you a tick mark in that category.
Spin's also working on a teleoperated scooter built by industry supplier Segway Ninebot. It's a three-wheeler powered by software from Tortoise that can be moved out of harm's way remotely or to an area where it's more likely to get a customer. Ed Ludlow, Bloomberg News, San Francisco.
Ed Ludlow there, taking a ride on a Spin scooter, and obviously you all know he made it back here safely. All right, Electronic Arts has agreed to buy the maker of the popular mobile game Golf Clash for $1.4 billion. EA acquiring Playdemic from its current owner, Warner Brothers Games. Golf Clash, which allows players around the world to compete in real time, has had more than 80 million downloads globally. And coming up, we'll talk about the state of e-commerce and the secondary market for luxury, fashion, and home decor with Julie Wainwright, founder and CEO of The Real Real, as they celebrate 10 real years in business. This is Bloomberg. 10 years ago, Julie Wainwright founded her luxury consignment startup from her kitchen table and picking up consignment items with a U-Haul. A decade later, The Real Real is a public company with millions of shoppers and 16 retail locations. We welcome Julie, now the founder and CEO of The Real Real, on 10 years. Congratulations.
Thank you.
We've talked a few times over those 10 years, and I remember the stories about the U-Haul. Now that we are here, does it surprise you how far the company's come and how much it has evolved? And I mean, what do you sort of see as the biggest accomplishment?
Oh, you know, I'll tell you what I didn't expect. I didn't expect us to change the culture, to be a leading influencer on sustainability, to be a thought leader and a driver of the circular economy. So when you think about, you know, creating a business and then having this other compounding impact, that actually is something I didn't plan on, and is something the whole company is proud of.
As you know, I've shopped on The Real, and I love that the things there were loved by someone else, or that they maybe are one of a kind. I could never get them again. But there's also this rise of fast fashion happening at the same time that the circular economy is becoming more compelling. How do you see that balance shaking out in e-commerce?
Well, our data shows that our customers that start really buying resale move out of fast fashion. So they're actually maybe not moving completely out, but they're spending less money in fast fashion, more money on resale, and primarily because they're becoming more and more aware of the environmental impact of the landfills filling up with, I think it's 1 truckload every second of fashion going into a landfill.
So you now have 16 retail locations. You have women, men's, kids, home decor, fine art. You've paid out more than $2 billion in commissions. Where do you see the biggest area for growth over the next 10 years?
Oh, we have such a long way to go. As of even last month, half of our new consigners, I think a little less than half, 45% of our new consigners, again, never have consigned before. So when you just look at where we are in the US, getting people to think about consigning, we're at the beginning, and getting people to really realize the positive environmental impact of the circular economy, just beginning, and we're only in the US. So certainly we have the ability to expand worldwide, but right now we have a long way to go here.
Now, I'm so glad you're here in person, because you were literally one of the last in-person interviews I did before the pandemic. It was the opening of the store, the Real store in San Francisco, and I think days later, the world was on lockdown. And the pandemic was a challenging time for retail in general. How did you weather that? And are you over those challenges today? I know that one of the biggest issues was supply, and just the demand was there, people wanted to buy, but getting them the stuff they wanted was hard.
Right. I mean, we're not primarily retail, but you're right. I mean, 3 days later after we opened the store, we had to shut it down. And we are a supply constrained business. And when you think of New York, the state of New York, but the city of Manhattan and the state of California were really shut down. California very quickly. We couldn't pick up product. So last year at this time, and really Q2, we went from, in Q1, we were heading 40% above year ago. We went down 45%. So we had an 85-point swing in our business. That was then. I'm happy to say that starting in Q1, our business started accelerating, and Q2, we published the numbers through May, and we're up about 55% versus year ago. So we feel pretty good. Actually, it was 106%. I'm giving you the 2-year total. So 106% versus year ago. So everything is on the rise, and it feels, knock on wood, things are getting back to normal. You were my last in-person interview, and you're my first in-person interview.
Well, thank you. I love the symbolism there. You're about to open your newest store Friday in Atlanta. What do the next 10 years look like? What are the goals?
Well, I mean, we just had a big company meeting before this, and I said my short-term goal is $5 billion. And in 5 years, which may be not aggressive enough, but we really want to keep planting the sustainability flag, changing people's both shopping and consigning habits, and be a worldwide company. So we have a long way to go. 10 years went by so quickly. In fact, it's almost a blink of an eye, unless you look at the pictures 10 years ago, and I'm like, oh yeah, that was 10 years ago.
And how, at that point, do you see the balance between physical retail and e-commerce, given that so much more of our shopping and behavior has moved online, and yet there is still some desire to touch and feel things in person?
So our stores have done phenomenally well, both in generating demand, but more importantly, supply. So if you think of our big challenge is to get more supply, remove friction. Some people are just much more comfortable dropping off at a store. So our plan is to get, 13 stores open this year. We're on track to that. 12 is Atlanta, 1 more in the Bay Area. And then we'll assess, what does that mean for supply and demand? The stores open during COVID got to break even very quickly on its strictest measurement, meaning on an incremental basis. But we're coming out of COVID, so we've always been primarily, and when I say primarily, 95% an online business. So we'll see how it shakes out. We're going to take it, just read the data and follow the signs.
And are we going to see more partnerships like Gucci? Is that a big part of the strategy?
I'm sure you will. One of the fun things we did during COVID, and you may have missed it, we worked with very important companies like Balenciaga and Jacquemus to upcycle. So we took their damaged goods that they couldn't resell, worked with another designer to reimagine those goods. And that actually has phenomenal potential. It sold through incredibly quickly. Right. So in that, I think we had almost 16 different designers we work with. Wow. So there's multiple ways we can work with them to reduce waste.
All right, well, we'll be watching for more of those potential partnerships. Julia Wainwright, CEO of The Real, great to have you. On a big day, we'll be looking out for the store in Hotlanta. Thank you. That does it for this edition of Bloomberg Technology. I'm Emily Chang in San Francisco. This is Bloomberg.